Every 3 months, thousands of public companies release their earnings reports, financial snapshots that investors rely on to understand how a company is performing. But President Donald Trump wants to change that. He's proposing that companies report earnings every 6 months instead of quarterly. On the surface, it might sound like a small administrative change, but the debate around this proposal touches the very heart of how companies operate, how investors make decisions, and how transparent markets are in the United States. Currently, the Securities and Exchange Commission, or SEC, requires all publicly traded U.S. companies to report earnings 4 times a year, every quarter. These reports show revenue, profits, and other key metrics. Larger companies also hold earnings calls, where executives answer questions from analysts about their performance and future outlook. While this system provides investors with frequent updates, executives often complain that it encourages short-term thinking. Instead of focusing on long-term strategy, companies may chase quarterly targets to keep stock prices stable. Trump argues that reporting earnings quarterly wastes time and resources. In a social media post, he claimed, "China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis. Not good." He believes companies would save money and management could focus on long-term growth, rather than the pressure of meeting quarterly expectations. Executives have echoed this sentiment. The Business Roundtable, which represents over 200 of America's largest companies, has said that quarterly reporting can lead to an unhealthy focus on short-term profits at the expense of long-term strategy. Not everyone agrees. Finance experts warn that less frequent reporting could reduce transparency and make markets riskier. Professor Salman Arif from the University of Minnesota explains that quarterly reports act as a check on company behavior. Less frequent disclosure could make it easier for companies to manipulate numbers or hide problems, increasing risks of accounting fraud or insider trading. Additionally, investors might be more surprised by unexpected news, which could make stock prices more volatile. So, what's at stake? For companies, lower administrative costs, more time to focus on innovation and long-term strategy. For investors, less frequent insights into company performance, potentially higher risk of market surprises, reduced ability to detect fraud early. It's a delicate balance. Transparency protects investors, but frequent reporting can sometimes push companies to prioritize short-term gains over sustainable growth. Changing this decades-long system wouldn't be easy. The SEC, which oversees public companies, has said it would prioritize the proposal, but any real change would require extensive consultation and debate. Even if the SEC moves quickly, we're likely years away from any actual implementation. Past efforts to change reporting frequency, like during Trump's first term, never went anywhere. Trump often compares U.S. corporate reporting to practices in other countries. For example, Chinese companies are said to plan for decades rather than quarters. While the comparison highlights long-term planning, experts caution that transparency and investor protections vary globally. U.S. markets rely on frequent disclosures to maintain investor confidence and market integrity, something that may be harder to preserve with semi-annual reporting. The debate over quarterly earnings reporting is more than just a financial technicality. It's about finding the right balance between transparency and long-term business strategy. Trump's proposal has reignited the conversation about how we measure corporate success, how we protect investors, and whether the current system truly serves the best interests of businesses and the public alike. As discussions continue, one thing is clear: the quarterly rhythm that drives Wall Street might not remain unquestioned for much longer.